Hello folks, what's up? Nice to see everyone here. Nice to be in the second episode of Send It. What's up, Roger?
Thank you. It's been a while, but I'm really excited for this one because we've got a really, really interesting protocol, one that I've been using a lot myself over the course of the bear market. So yeah, I'm excited to get deep with Gearbox.
For sure. Nice to have you guys from Gearbox on. We have Amplice, we have Ivan. What's up, folks?
Hey, hello, gentlemen.
Hello, folks. What's up? I was also honored actually to do something with you guys probably about a year ago, even almost. With a small sponsorship. I was in touch with Muggle Sect back then on my Another Day in Crypto blog. So of course, just want to make sure that this is also out there because I'm also very fond of Gearbox myself, and we're very excited to have you guys here. We Send It, as you know, we want to bring a new element to Leviathan and our shows, and we really want to emphasize on deep dive into a protocol, let it emphasize its strengths, whatever we want to share your story. We really want to hear your side of things. And really nice to have you on, and it would be great if you can even start by sharing how did you guys even get into the crypto space? What did you do before? When did you hear about it? And let's just start from there, and then we'll talk about how did you guys met each other and made Gearbox possible.
Amplice, want to kick it off? Yeah, I'll go after you.
So I do marketing at Gearbox, or memes. How I got into crypto. I mean, you guys, before we started, you guys were talking about that Quart tweet. It's not exactly like that, but something like that. But basically, I definitely knew about Bitcoin when I was pretty young, but I was like, this economic model doesn't make any sense. I just ignored it. So joke's on me. Then around 2017, I was working at a kind of small scale private equity company, and one of my partners was like, we should do an ICO. And I looked at it, I was like, that seems like a scam. Why are we trying to scam people? He's like, yeah, but you can make whatever millions. We ultimately. I won that battle. We didn't end up doing the ICO, but basically we ended up doing some kind of marketing consulting for projects, doing their slides and things like that, and doing investor intros. And basically from that, I learned about Ethereum and smart contracts. And I was like, all this ICO stuff, 99% are scams, but smart contracts totally make sense. And the economic model of Ethereum makes more sense to me than Bitcoin. So then, I got kind of red pilled for the first time. Then so I got some ETH, and then bear market happened. I stopped paying attention. And then around 2020, obviously, I just poked my head back in, and I was like, oh, damn, there's actually real DeFi going on. All this stuff that people were promising back at the ICO stage is okay, 99% of the projects actually went to zero and disappeared. But there's 1% that built through the bear, and the stuff was actually live, Synthetics, Maker, et cetera, et cetera. So, 2020 DeFi summer, and then the rest is history, I guess. Started doing videos just for fun I don't know if you guys were around for Base.money, but that was the most glorious time in DeFi summer. So it was just doing stuff for fun. It felt it really felt like early internet days for me, which is kind of what kind of drew me back in. And then with Gearbox, I saw they were looking for somebody to do memes. I sent Ivan an email, I think, with a bunch of videos that I did, and he was like, do you want to do a video for Gearbox? Do you want to do a video for lobsters? And basically that's how I got into Gearbox. Yeah.
Sounds good. I actually didn't know most of it. Funnily enough, many of Gearbox contributors haven't even met in person. I think majority even haven't. I met Amplice at conferences twice. If you would send me a picture of him, I would not actually recognize him. I have such a bad face memory, I would say, I don't know, this is some random person, honestly. But my journey, I guess, was less mid-curve, was even worse, or high on the mid-curve. So when I heard about Bitcoin, which was mid-2017, I bought it immediately at the peak. I didn't think about it. Economic models, viability, not relevant. Buy the peak. That's what I did. Then I thought I was a genius investor, and I bought 3 ICOs or like 4 ICOs back when it was like KuCoin times and everything. And that went up, and I was like, holy shit, I'm a genius. I'm an absolute freaking genius. Then it all went to zero over the course of 2018. And that didn't take a year to go to zero. That literally took a couple of weeks because liquidity was very thin, and it was mostly like Ether Delta, right, instead IDEX. So it didn't take too long for that to drop really hard. But I was studying then and trying to work in a startup, and it turned out the startup I applied for, which was doing illegal work, like in Amsterdam, like legal company, everything, they wanted to do a shitcoin. So unlike Amplice, I said, hell yeah, let's do it. Because there wasn't much other choice. The boss told me either you're going to be creating research for real estate SaaS platforms, like software as a service, right? I spent on it 2 hours, and I'm like, oof, that feels bad now. Like, not going to be doing that. But of course, I'm exaggerating a bit. But anyway, I was on the project side. Meanwhile, I was angeling. I never quit the market really since 2017, since I was working and investing kind of side by side to an extent most of the time. And then during DeFi summer, managed to get in a couple of good spots, allocations, I guess, a couple of good farms, and quit that project essentially, and was for about a year essentially not proactively doing something. It was mostly Lobster DAO again since 2018, all the time. I think I haven't spent less than 6 hours a day in Lobster DAO in the past 5 years. And then at some point came across a friend of mine, well, he used to be a friend, now he's a co-founder, said, listen, there is some guy who built some cool thing about some Uniswap margin trading fully on chain on a hackathon that was January 2021. So almost 3 years ago at this point, right?
Yeah.
If I count correctly. Yeah. And we had a call, but he was alone, of course, as a solo developer on a hackathon. So we wanted to invest and just like advise and do something there. But of course, one person isn't the team you can really invest in, right? Like there was no structure, nothing, no plan. We were just a dev doing fun stuff. So we thought, okay, we're just going to get him and slightly help. Bam, 2.5 years down the line, we have 5 kids, almost, 2 years down the line, there is now a DAO, a protocol, and me and Amplice are each talking every day. So that's basically.
So Ivan, do you have like any engineering background or computer science?
No, I'm a fucking moron. No, I'm a moron. I'm as moronic as it gets, honestly. I was studying sociology and law, and with my ADHD, I actually don't know if I have it or not. By the sound of it, I probably do. I didn't want to read absolutely anything that was more than a page long. So you can imagine I never read any white paper, right? White papers, I can manage. Other stuff, no, thank you. Abstract does it for me. But yeah, basically social sciences background. I was just working in marketing since I was at school because I kind of had to be able to buy drug now to feed myself. So I kind of always had that marketing background and was doing some social media marketing on the side. And at some point I was doing it during university for a binary options platform. And at some point they added crypto. So that was my introduction to it, basically. Kind of natural to an extent. So I simply continue doing marketing related stuff. So same as Amplice, I do marketing, but in crypto, marketing, biz dev, investor relations, right? They're pretty much interconnected things because it's all about narrative. Investors want narrative, marketing is narrative, and BD also about narrative, right? But no, I have no technical skills, nothing applicable. So when people joke about if you quit crypto, where are you going to work? I don't think I can work anywhere. So unfortunately, I'm stuck in the
Okay, I think that makes 4 of us.
I think I can identify with a lot of other stuff. What's that?
I was just saying, I think that makes 4 of us.
No, but at least you're a doctor.
Well,
nice. Then you can start a podcast. Oh wait, sorry.
Yeah.
We actually can.
Yeah, I'm the doctor who's quit and gone full-time crypto.
I know another guy who's actually a very good DJ, and I think you might know him, Lim0 on Twitter. He's actually, during this bear, he went into doctor stuff like almost 24/7. He said there is nothing to shitcoin on, so he'd rather help
Fair
people.
enough.
is an interesting position. It's not something you hear very often. Yeah.
So, you told us a little bit about your background. Kind of, how did the Gearbox story start then? And you kind of met the guy who was coding himself. He was by himself. How did the team kind of form from there?
Yeah. So January 2021, Global Hackathon. He was in the finals there. That's how we spotted the project. Me and APR, I can't pronounce his freaking, I don't know why he made that nickname, it's unpronounceable. Basically had a call with him, thought to invest. He was one person, the developer. So we either had a choice of like, just let it go and see what he does, or actually join in with him. Decided to somewhat join in and try it out. So he made, I wouldn't say an MVP, more so like put some docs and stuff together to turn it into a narrative. Back in the day, Andre was very popular. I mean, he still is, but many people started hating. So it's a love and hate relationship depending on who you are. I told Andre, look, he's like, Ivan, this is the first developer that seems to make sense that you sent me, apart from all the other scams you shared with me before. I'm like, that's a total lie. But anyway, he gave some grant to him so they could continue some development without even asking anything back. So from my perspective, Andre is a god. And people who were in DeFi, they kind of remember that as well. And then a tiny fundraise happened also just to pay for audits. Audits were paid for, and V1 was launched later 2021. Then at the same time, the DAO was launched, and I think Amplice joined literally. I would say he was there from almost the beginning, just maybe not in the role of a contributor. And yeah, after that, let's say, I think mid-2022, DAO was properly formed in terms of like they were actual external participants and contributors and governance, and it has been functioning to this day so far. So far, so well, I would say, depending on who you ask. But yeah, that's the story basically. Anything I omitted that might sound like interesting, please.
Yeah, it sounds like you've had quite a journey, just from starting, there's a one person team to kind of where you are today. Like, it's really impressive to just see that kind of growth. And to be honest, I know it's been 2 years, and in crypto 2 years is like 2 decades, but that's quite a short period of time really to build so much. So, props to you for doing that.
Thank you. I'll pass it on to developers. Unfortunately, I cannot take any of that.
Neither of us build anything. So
yeah.
we just, yeah.
We are not even good at building pyramids. As you can see in the secondary market, we aren't even good at doing that. So can't even call a builder from that perspective.
So I think just an important thing to actually mention for any of the users, viewers who are watching that aren't familiar with Gearbox, could either of you just give us a brief intro? What is Gearbox and what can you actually do on it?
Yeah, sure. So the most straightforward explanation that I can give is in DeFi before Gearbox, let's say, basically there's only, like, if you're borrowing money from Aave, for example, you have to put in more assets than you borrow, right? Which it's not the best. Aave is great, but there's only specific use cases where that makes sense, because obviously borrowing, traditionally, you want to borrow more than you have. If you had the money, then, what's the point of borrowing? With Gearbox, the way that we've solved this is when you put in your collateral, it's kind of like a smart, like a credit wallet, essentially. You put in like 10 ETH, okay? And then we can lend you up to like 100 ETH, but it has to stay within your smart account, essentially your credit account. And then you can do a variety of things with that. And we're always adding new things that you can do. But you can basically, you have like up to 10x of the collateral that you put in. You have up to 10x the spending power, as long as it stays within the parameters that we deem safe. And then when you're done with, whether it's trading, farming, et cetera, staking, all that stuff, if you've made money, then you can take your money back, pay back your loan, and your returns will be 10x minus the cost of borrow, essentially. And that's like quite different from the way that kind of older school lending in DeFi is structured.
Could I try to twisted differently, just to give more scope perspective from like in a different way. Gearbox essentially tries to make on-chain credit possible. So credit, if you think about it conceptually, it's about more capital, right? Leverage, perps, looping on Aave, all essentially achieves the same thing, which is more exposure to an asset that you want, right? You could say, to an extent, all of that is credit, just structured differently. Gearbox also tries to give you more capital to do what you want, just through credit accounts, and that is essentially our account abstraction. Imagine Gearbox giving you a leveraged wallet that you have 10x the funds in. So let's say if your MetaMask had 10x the amount of funds in it, and you would be able to go to other protocols and utilize them like you do today, just with more capital. Again, that is conceptually, right? Of course, there are many ifs and don'ts of how it actually functions as a protocol, but the point is it's about basically giving you a leverage wallet that you can go use anywhere. NFTs, DeFi, RVAs, whatever it is. And to be more concrete, of course, you could see them as leverage trading or margin trading. You could see it as leverage farming, and other use cases are possible as well, depending on how you put different things here and there together.
So tell us about where the liquidity for this comes from.
Conceptually, that's actually at the beginning. People were asking, okay, you have this credit primitive, right? You allow this borrowing at 10x, for example, and then using other farms, other protocols, right? Why don't you just do it on top of Aave or on top of, let's say, somebody else who has the capital? Well, in that case, you would need them, their governance, to give you a permission to utilize their capital, right? Because either the capital that you have in the pools on Aave or Maker or wherever, it's either every user separately gives you permission to use that capital, or it's the protocol itself that does it. For example, another way, every stablecoin protocol has something like Maker's D3M module, where they essentially print, right? Maker is able to print into another protocol, conceptually speaking. So that was the answer. Like, trying to build a new protocol and expecting that to happen in large amounts is impossible. So liquidity needs to be sourced. And that is a similar issue that every lending protocol faces, is even if you have borrowers, you need to source it. So yeah, passive liquidity from those who just want to earn yields is normally sourced like by any protocol you can imagine. So there is not an insurance and stuff in the background, but conceptually it is just sourced because people want to earn passive APY without liquidations and anything else.
Yeah, great, good answer. And then kind of on the other side, with the borrowers, the credit account users, how does it work for them? How do they kind of set an account up?
Great question. So the sexy part is really here, indeed. As I mentioned before, it's like a leveraged wallet where you have more funds, and then you're able to go to other protocols that you already like and execute, trade, farming, whatever there. The way it works is the following. Let's say you're a leveraged borrower. You have 10 Ethereum yourself. You want to go 5x. Essentially, the 10 Ethereum of yours and 40 Ethereum from the pool, from the passive pool, goes into your credit account. That credit account is kind of like your leveraged wallet. It's a smart contract. It's a smart contract account. Now people are more familiar with it, right? With account abstraction becoming a thing, people know Argent, people know that at this point EOAs, which are just your MetaMask account or whatever else, they are more of like they're not a programmable tech really. You cannot give it permissions, you cannot do stuff with it. A smart contract wallet, you are able to do more stuff with it. So conceptually the same thing here, just done of course fully differently as a protocol. That capital now, the 10 plus 40, now sits in that smart contract account. And that smart contract account has certain permissions. You can do anything you want within the allowed list of assets and allowed list of protocols you can interact with. And that is done for security purposes. Because if that wasn't there, you could conceptually just borrow, essentially have the 50 ETH, and buy some fake Uniswap shitcoin that you just created yourself, essentially spoofing the money out, right? Makes no sense, immediately hacked. So that is why there is collateral onboarding similar to other protocols. For example, you could conceptually add any farm, any tokenized asset, but there needs to be liquidity for it. So essentially there is a collateral onboarding process like you would see pretty much anywhere. But that's the thing. These are not vaults. They are not strategies. You are not limited to some certain, locked contracts or anything. You essentially just have a leveraged wallet. You are simply limited within some box, right, of what you can do. But within that, you can do anything. For example, you can borrow, like I said, right, you can borrow 5x Ethereum and you sell it to USDC. What does it create? It creates a short position, essentially. But usually that would be it, right? If you would be on leverage firms or whatever, that would be it. That's the end. You can only change your health factor and put collateral or add more. Here, that USDC is still within your credit account, your smart contract account. That means you can now put it into a farm that is available. So now you have a 5x short on Ethereum that is at the same time farming stables. That means your stable farming can essentially be paying back the borrow rate you are doing. So you have a free short conceptually, or a short that basically pays more for itself. The same way you can go into a loan. 5x borrow USDC, buy ETH, and then with that ETH buy SCH. So essentially you are levered ETH into leverage taken as a yield, and that can be paid back. And that's the thing. It's about the ultimate user freedom to allow you to construct any position you want. You can have it in a complex way, or you can just have a short-term loan. To add to it slightly, that's the last thing I'll say now. Get an exposure to an asset like 10x ETH, right, or 10x short ETH, doesn't matter. There are many different ways to achieve that. Similar in the real world, right? Let's say you want to get exposure to Spanish real estate. You can buy physical real estate. You can invest in some local companies that manage real estate, essentially getting some indirect exposure, right? You can buy local rates, like the real estate market indexes. There are different ways to get to the same goal, but quite often the path to the goal is very important. The same thing with ETH loan. You can do leverage looping on Aave, like people have been doing back in 2018, right? Because there was no perp DEX really. You can do it on a centralized exchange. You can do it on perpetuals. You can do it in futures. Your exposure would essentially be somewhat the same. It would have a different fee structure or something, but it would be somewhat the same. This is just the way we are doing it. It's the ultimate freedom towards achieving that exposure, because you simply, again, it's like I give you a bag of money and you, like, I don't know, invest in an ETH. Now you just go put more into that. So it's about the ultimate freedom that as long as you're within the allowed list of protocols and assets, you can compose, construct whatever positions you want. I'll shut up now. I think I said enough on the monologue. I'll let Amplice add the other things.
No, and
I think that's pretty clear.
It's good. I think we're just starting to get things out of you, and I think that that was a very good explanation, actually. Did you want to add something, Amplice?
No, I think that's a pretty good explanation. I mean, just as an aside, I think like I was back before I joined Gearbox, I was like just basically punting shit coins and like quote unquote investing, as people say. And I didn't really have any plans to work at a project. And Gearbox is like the first thing I was like, that actually like could be really, really powerful and actually kind of quote unquote make a difference in DeFi, because it's actually a new thing. You know, back when everybody was like forking Uniswap on a new chain or like all this nonsense. And I saw like the design of Gearbox and it just really made sense. And to me, it's always like the thing in my head was like, it's a smart wallet that has credit or leverage built in. And like that could be so powerful because I think like a lot of users still spend a lot of time on centralized exchanges and things like that. I mean, you can see what happened with FTX, blah, blah, blah. And I think that's because people feel like they have more flexibility on these centralized exchanges. Like they can get exactly the exposure or whatever that they want, right? But with Gearbox, hopefully, like as we keep adding more and more things that we deem safe, the whole of DeFi is available to you, but with leverage. That's basically the goal.
Just a question.
You want to see something funny?
Go for it.
Sorry.
Show us something funny.
I can share the screen on this one. It's not funny. It's more so an interesting something. I don't think I can share the screen.
Whilst Ivan is just sharing the screen, so I thought I'd just ask him, how do you decide which assets get added to these credit accounts? Who decides? Is it the DAO or is it the team?
It's the DAO, yeah. It's a collateral onboarding process similar to any other lending protocol, really. Or not even just lending protocol. Anywhere where you have collateral onboarding, the parameters are essentially the same. The asset needs to be liquid enough, right, on DEXs and so on. So there are like a few parameters that go into it, but they conceptually the same. The bigger the liquidity, the bigger the LTV. So nothing really different in regard to that. But something just to add to Amplice's point is, when we were doing the V3 deck, just like to show the update of what has been happening, not as a fundraise, but more just like, to keep the brand up, to update other protocol partners and whatnot. One thing that many startups always rely on is they say the market will grow like more than 10x from here, right? You usually don't build a startup if you don't expect the market to grow, which is a fine assumption to make, but it's a bit like I will sit by the river and I will wait it to get bigger. What we did is we looked, that's our PhD math guy did. So if you lied with these numbers, don't blame me. We'll find him after that. But basically, if you look at the total on-chain interest, total open interest, perps, futures, whatever, in crypto, the DeFi of that is only about 1.5%. So even though DYDX, GMX, and a few others have grown, comparatively within the market, they're still tiny. So that means we don't need to see the market grow 10x from here. DeFi can be just eaten more from the Fi, right? The D in Fi is still small, as it says here. So the same thing Uniswap has been eating its share from Binance and Coinbase. The same can be expected for everything else: options, perps, credit, lending, whatever else. It's just that we think that DeFi has grown. Comparatively speaking, even not with comparing to the $1 trillion real world market, right? Screw that. Just compare it to whatever capital already is in the ecosystem. There is still a huge room to grow just by offering a better product. And better product comes in many different shapes, right? Is it better security? Is it better UX? Is it simply the same good UX but no custody, so it's safer to an extent, right? That is something to figure out. That's what every protocol product is trying to figure out.
No.
Sorry for stealing the spotlight a bit.
I think, just to add to your point, like you said, it's pretty crazy that derivatives in general just have such a small share of DeFi or I should say finance at the moment. You said 1.5%. It's tiny, right? And even if it was to 10x from here, it's still tiny. So yeah, a long way to go, but I think continue to develop, and I don't see why we shouldn't see that pie growth.
Yep. How do you guys feel that Gearbox is actually playing this role of what you just mentioned, Ivan, of actually using the fact that the market doesn't have to grow, that you can grow from the inside? How does that fit into the Gearbox narrative, if you can understand what I'm asking?
Great question. I think I maybe partially understand it. If I don't, you can just correct me after I try to answer. In a broader spectrum, I guess I'll share the screen at the same time. Well, not. In the broad spectrum, Gearbox presents itself as an on-chain credit narrative, right? It's a primitive for credit to be used anywhere, anyhow. That is a broad narrative in terms of composable credit. Now, that might seem sexy and fun, right? But the question is, what is it that concrete? Because what you see a lot, not just in DeFi, but in general in crypto, is teams usually have to rebuild the protocol stack and then make the best product on top of it, right? You kind of are forced to do two things at a time. While the protocol stack is all about being open, transparent, having governance, right? All of those processes that might be tedious. And products require iteration, quick delivery, A/B testing, right? You cannot really A/B test protocols because you cannot A/B test 100 million, for example, in TVL, right? As you see, protocols at max ship one new version a year. So the cycle of updating products and doing new stuff is very short. But anyway, why I'm saying this is because Gearbox as a protocol tries to be a primitive for anybody to build on, for anything, blah, 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 we know the drill. But how it comes to life in a concrete sense is so far what happened in V2, we did leverage farming. That one grew to about 130 million total CVL. It had no incentives for the leverage side, and it almost had max utilization all the time. So we saw that there is need, there is potential. And that is even while having some whitelist, while having a large borrow limit. So we had a lot of bottlenecks, and even they didn't stop users from trying it. Leverage farming is great, but when credit markets collapse, which was the past year in general, right? Private equity, VC arms, any kind of exposure in terms of credit and leverage was deleveraged, right? The world was deleveraging to an extent. We could have waited around for delta neutral to return, farming delta neutral the same, right? But we just thought, okay, what is the other source of credit or application of credit that is all seasonal? And that is margin trading. That is where people are prepared to pay higher borrow rates because they also expect higher returns. So essentially with those two, we balance it out because again, leverage farming is great, but it's a seasonal thing. It comes from premium on assets and volatility being there. When there is no volatility, there is no premium on assets, you can't have it. Margin trading is all seasonal. So we realized that basically the question that I'm trying to answer is through two things for now. Leverage farming, we've done it in V2, and V3 is more about margin trading. Of course, both. Again, the protocol, the underlying creative primitive is the same. You can build any product on top. It's just that you still need to deliver that product to an end user in a more concrete, UX-friendly button, right? People like a button. Which button do I click to make money? And that has to be abstracted. Exactly. That is why you see every startup... Exactly, yeah. That is why you see every startup building a dashboard with 100 buttons, which we do as well. Like apparently you can't just get rid of it. And then Google, Uniswap, and whoever else has 2 buttons, right? A simple thing, one window, two buttons. That's all. So that's what everybody needs to get to.
I think that brings us to a very nice point. Talk about version 3.
Go ahead, Wood.
What would you like to know? Fire it off. We can talk about it we can talk about it for hours, but which things do you think are most interesting?
Talking about kind of how credit is changing now with version 3. How yeah. I think that would be a good place to start.
Mm-hmm. Let me try to dive it from the background a bit more. So let's touch upon AMMs first. AMMs, AMMs. Previously, there was an order book model, and then it became AMM, and then they were all granularized. So essentially, I forget how to rightly get into it, but basically, it is now granular. There is one asset, and it is trading against something else on Uniswap, right? Let's say Gear to USDC. It's not granularized. It's not like one same order book or whatever. When it comes to lending, when it started P2P, the market was too small. The market was too small for P2P to really match essentially the buy and the sell side. So that's why protocols like Aave and Compound, they went with the pool-to-person model, where it's easier, or pool-to-pool rather, where it's easier to aggregate, right? It's easier to aggregate demand, there is an utilization curve on top, easier to bootstrap the markets. Now, what we see with lending protocols, especially in the past year, after Rari Capital, Euler, Ajna, Morpho, is they're trying to granularize risk even more, right? Aave has a one pool model, essentially. This has many different pairs, right? It's essentially abstract lending into AMMs to an extent. It has its upside and its downside. So with Aave, the upside is easier bootstrap, easier to add new assets, easier to have liquidity be big enough to match people who want to either borrow or to lend. With the P2P model, what is more difficult, of course, is to match, right? Even when, for example, I try to use the new software that has P2P calling, and it has 3 people, and quite often one person just disappears, and P2P has its downsides. It's great for security, you can own your own risks and whatever, but it has the downside of not essentially grouping it all together. And now I lost the question.
Yes.
The V3. So Gearbox doesn't try to answer that question of what is better and how. We have been modular from the very start, which has its benefit. It has complexity, but it has benefits. Why? It's because now there is a pool, and then people can borrow from the pool based on some LTVs. There are some assets being added like collateral onboarding. Let's say some big lender can say, I don't want to trust this, but I would like to have Gearbox ecosystem technology, whatever. Let's say Gnosis DAO Treasury. Gnosis DAO Treasury can create their own lending pool, their own credit manager, and reconnect it in such a way that either them or their governance will be decided on what assets are actually onboarded and at what LTVs. They can even restrict who is being able to take that leverage to be a borrower. They can even restrict to how that is being executed. So Gearbox, due to modularity, is able to reconnect a lot of these different pieces. For instance, you can have a pool where, people just ape in and then they just get the best APY. You can have a pool where people lend in money so that others could trade shitcoins, like really long tail. And again, for passive side, they are not exposed to it directly because liquidations are still there. So if collateral onboarding happens in a normal way, there is no issue for that. You can even imagine an immutable pool where assets are added and it's never changed, right? For example, liquidity users are fans of that, where you cannot change what you do, right? Like it's a Brickstone protocol, and that is why it has value to people. I, for example, use it quite a lot myself as well. And then you can even imagine institutional KYC pool. So again, this modularity helps to make narrative as a credit primitive. The narrative, primitive, whatever. Credit being on-chain.
That's so interesting.
So that was what the work was done with V3 to essentially enable it on the bottom layer. And now is the question of how do you bring it to the user, right? How do you abstract enough of it so then it's actually usable without having to learn all of it? Let me stop here so that you can maybe ask a more concrete question.
Yeah, and I think my next question was really like how does a user interact with these different pools?
Great question. So it has two sides right at the beginning, as we said. Lending side, where just passive liquidity providers, and then the borrower side. The lending side is quite simple. Because there is risk segmentation in V3, you can decide later on whether you want to lend to a risky pool or to a blue chip pool. So from the lender perspective, the choice is minimal and the action is limited. Just lend. That's it, right? You go. Passive APY. That's the concept of it. Later on, other protocols could lend into it as a yield optimizer. There are many different ways to talk about it. But the usage is more complicated on the leverage side. How do you abstract that credit complexity, right, for them to use? Because somebody who is using margin trading is not going to be liking the same interface as somebody who is farming, right? Remember any farming interface in DeFi. And remember Binance perpetuals, right? It's absolutely two different things. They have nothing in common. So even though it was possible to margin trade with V2 with Gearbox, very few did it because the interface didn't prompt the user to do it. Again, you need 2 buttons, right? You cannot have 100 buttons, and that's the complexity that has to be abstracted. So one of them will be same as V2. It will be an interface tailored towards farming. So there you have like more passive positions. Liquidations are unlikely to happen very often, and that's basically it, right? You just choose the best farm. And you're going to have a trading interface. The margin trading interface should and will look closely similar to, I think there is a small snippet, similar to how you would expect it to look, right? Quenta, GMX, DYDX, whatever. It's not going to be as slick at first because, again, those teams have been doing that work on interface for a longer time, but that's basically the idea. And again, the architecture and the protocols and the contracts for both of these will be the same. It's just that an interface abstracts complexity into something where a user has concrete path from start.
And whose idea was it to kind of make these different interfaces, or what were the challenges that came across when building these different interfaces?
Oh, cool question. I wish I could pull the images of the first interfaces. So the first idea was how Gearbox a bit in evolution. That was spring 2021. The idea was to just margin trade on Uniswap. That's all. And the interface that was made is just a fork of Uniswap interface, but with the leverage button on it. So the idea was to like give you the same, right, but just with leverage. It had 2 issues with it. First of all, is that some people could think that it's a scam, right? Like, what is this? Like, an exact copy, right? Which probably wasn't really a concern. The second issue was that quickly we realized that this credit is a primitive. It's not just for Uniswap. It will be applicable to many other farming, trading, whatever. So then what happened? Okay, how do we justify that? What we did is we made 4 different forks of interface, 3. It was Uniswap, I think, Curve or something else, and Wire. Essentially letting people know that, listen, you are used to Wire interface, here is a fork of it, but with leverage. And then we thought, okay, so what? If you have 7 protocols, we're going to have 7 forked interfaces. And DeFi interfaces by nature, including ours, are shit as hell. They're terrible, they load terribly, the code is terrible. Like it's basically shit, right? Most of protocol developers are not good UI developers. So that was just the issue, that it wouldn't be possible to upkeep it. So okay, how to abstract it? What happened with V1? There was similar to Uniswap interface in terms of the buttons, but it was very different. So it was fully rebuilt. And it was not the same copy. I wouldn't even say it was similar to an extent. But the point, there was a window and you had a Uniswap trading, this like square thing in between that you had. But there were 2 tabs, one farm, one trade. So in trade, you would execute the assets, and on farm, you would go into farm. And it turned out that both farmers and traders found it complex because it was not tailored towards either. Like for trading, you expect different stuff, right? When you trade on leverage, you actually want that chart and then some numbers behind it and P&L. People are used to it. Every trading course that you do in your life has that interface as a example. So that's what we realized after we do, that people expect it and there is no reason to redo it for now. That is how it should be. With the farming interface, it's not changing that much from V2 because there wasn't much of an issue with regard to how it worked. It will just display farms better, and it should be more interactive in terms of like load a bit quicker and everything. But we didn't see much downside of how we deconstructed it, because that one took a long process to make anyway. So there were a lot of iterations in between.
Interesting. Advisor, do you have a question at the moment? I wanted to ask one more thing, if that's okay.
Oh, first of all, you can feel free to ask. I got sure some stuff.
I'll just ask one question and then I'll let the advisor talk. In regards to the trading aspect, perhaps Amplice could answer this one as well. We've talked. I know in the past I've heard like talks about on GMX, for example, or any perpetual exchange, you got traders on one side and you've got LPs on the other side. And if the traders are winning, then the GLP users or holders are the ones losing out, for example. How is that going to change in Gearbox with the new credit systems with V3? What are the updates that we've got with V3 in that regard?
Yeah, sure. So if you think about kind of how trading works right now in crypto, right? There's like trading on centralized exchanges where you're trading against market makers, right? Then there's the VAMM model, which like perp.fi uses, where you're trading against, a combination of market makers and quote unquote the house. But essentially like the way that perps work is like the perp protocol is hoping that longs and shorts are mostly balanced against each other so that they don't have to worry about like making up the difference. But it's never the case that those things are balanced. There's a structural imbalance with longs and shorts, which is why the virtual AMM model has like been a bit spotty here and there. And like there's been various cases of like, we were imbalanced on the longs compared to the shorts, so we had to go into our insurance fund and make up the difference, things like that. And then there's like the GMX model where, like you said, there's LPs, right? And they hold, in the GMX case, I think it's like BTC, ETH, USD, LP, like you have those three assets together and then the traders trade against that. And if the traders lose, then the LPs win, like make money over time. But if the traders are good, then the LPs potentially will lose money over time, right? And so in the short run, that model can work because you kind of, in the short run, like people are new to that protocol. Maybe you get inexperienced traders coming in, but as inexperienced traders lose money, they're going to drop off, right? And you get better and better traders. And then essentially like your passive LP position is trading against some of the best traders there are. And so they start to lose money. And once the LPs start to lose money, then like, why would you keep your money in there? Then you're going to withdraw your liquidity. Then you have no liquidity, right? So I think essentially what it comes down to is like the decentralized perps thing. They haven't really solved fully how to have a protocol that doesn't rely on market makers. Okay, so let's put that aside. The difference with Gearbox is the way we're thinking about it is like the leverage we provide and the assets that you trade are pure. Meaning if you lever up on ETH, right, and you like hold an ETH position, a long ETH position or a short ETH position, either way, it's like you're actually holding real ETH. It's not a virtual ETH that like if the VAMM can't pay it, then your virtual ETH goes away, right? It's that's real ETH that's on chain. The same with any other token that you're trading. Like if you're trading, like let's say you're punting a Lido, right? Like you want to go hard long Lido, like 5x leverage or whatever. That's a real Lido token that you're holding. It's not like some abstracted away virtual Lido that represents some money that somebody owes you. So like we're thinking of it as like pure leverage. And the way that the reason why that works is because when you trade on Gearbox, you're not trading against Gearbox LPs. You're trading against Uniswap LPs, right?
Just them. You're trading against the entire, not just them, right? You're trading against the liquidity of the entire market. So that's the benefit of perps. Perps have to sorry to jump, just one thing. Perps have to maintain the book themselves, right? They need to have the funding rate, whatever they need to maintain. Here with Gearbox, you're trading against an entire space. You're trading against the entire market where the liquidity is, wherever it is. and the best solvers and market makers that already exist, they rebalance the dexes and whatever themselves. So you don't have the issue of weak liquidations happening because you are trading against real liquidity. There is nothing virtual in it. It also has the benefit of, as a result, not having a funding rate, because there are no two sides to maintain of the book. There is no funding rate. It has downsides, of course, right? So all products have their upsides and downsides. You can get the same exposure to this. You can get exposure to the same assets in different ways, and the path, as I mentioned at the beginning, can vary a lot, and depending on your risk profile or your what you prefer, have different, right? For example, GMX allowed, I don't know if now or not, for that zero slippage, right? That is good, but if you're trading against the entire DEX market, then you would probably have somewhat of the same experience anyway. And end of the day, that also comes with a downside with regard to LPs, right? Then the other thing is that if you maintain your own virtual AMM, as Amplice said, that has its issues, that if it's not deep enough, many users can get exposure. So then they simply cannot even execute trades on it if they can't enter the size. If you're doing it against the entire spot market, you are able to do that. And of course, no funding rates. So you don't have to maintain two sides of the book. Funding rates can get huge. On SEX's funding rates, last half a year, they haven't been huge. In the bull, of course, they were 50% and up. On perps, on DEXs, actually funding rates are not low at all, and they're usually pretty high. While borrow rates, like lenders would be happy with 10%, right? Happy percent passively without any risk taken, essentially. Low risk taken, let's put it like that. While if you give 10% to margin traders, they'll also be happy. So essentially it helps balance this too. I'll shut up, Amplice, please finish your part.
Yeah, the other thing I'll say is like I have a metaphor in my head. I don't know if this makes sense to people, but it makes sense to me. So essentially, like, you know, these not crazy, like these super deep into conspiracy people, they think the government's going to collapse and we're all going to need to rely on guns and whatever. And so they like stock up in gold. And then you like the ads targeting those people are always like, oh, buy gold on this whatever website. And like, but half the time that gold that they're buying is like some financial product that mirrors the price of gold, but isn't actually gold, right? But in a disaster scenario, like you want physical gold in your house. That's the only way it's going to work. If you have like a claim to gold in some warehouse in Kenya or something, you're never going to see that again if like the whole government collapses. Like you're actually holding the real asset makes a difference when things blow up. And like similarly, like if you're using Gearbox to leverage trade, you're actually holding the real asset in your credit account, as opposed to, let's say, like, oh, if you're trading on FTX, that's not yours, that's FTX's, as we can see, right? If you're trading against some protocol, even like a VAMM, there's no ETH like somewhere like representing your position. That position is a virtual position that maybe you have a claim to if things go well, but if things blow up, that claim goes out the window. Whereas in the credit account, you can see the actual assets that you're trading in the credit account. It's like much more pure. You're actually holding a real asset. Yeah,
that makes so much sense.
What I wanted to say.
I like it. That was a good one.
Oh, I wanted to ask something that actually I probably should have asked a bit earlier, but still, I want to try get just the exact essence of it. Like, what do you guys see as the most basic issue that Gearbox solves? Who is the audience that it, in your mind, fits the most? And let's just start with this.
It's a good question, because Gearbox, as many other projects in this space, or DAOs, whatever, it has a protocol and it has a product, right? Or products. So as a protocol, a reply is anybody, right? Anybody can be building vaults with it, anybody can be doing anything, which is true. It is built as a primitive, but it's a bit of a vague reply, right? You can tell me, Ivan, screw yourself, like that doesn't help me realize it. So that's very true. So that primitive comes to life through abstraction into simpler products. And that means they're going to be different. It is about more capital, about more credit at the end, but it's a different path and a different user expectation, different user basis, different user size. And because a farmer and the trader are two somewhat different user bases, right? So the leverage trading there, now let's start with farming. With leverage farming, it's a very interesting proposition because it, to an extent, functions as a yield optimizer. Because if there are protocols that are integrated, that have a high yield compared to what passive lenders are happy with, it functions as an interesting spread protocol, essentially, that you can even build rate markets on top. Let's remember the Anchor and Terra, right? They were people who were happy with 10% passive, all these Silicon Valley startups that were doing it, right, just deposit passively. And they were those who were unhappy with even 20%. Remember, even last year, Frax was yielding more than 10%, while plain USDC was 3% or 4%. So during the spread markets, farming is a very interesting opportunity for just farming, for the rate markets, for the spread in between. It becomes like an interesting yield optimizer credit primitive in between. That's for farming, right? That is for passive strategies and stuff like that. Another thing is more active strategies where on-chain funds that actually a couple of them have used and still do use Gearbox, where they see the discrepancy in rates between many protocols, they see the risk-reward model different, and they try to get that risk-free, delta neutral, right? That's what they call it, the delta neutrality. So essentially, they can build complex positions with shorts in ETH and then hedging that exposure. Elsewhere, they utilize a lot of different tools in between. That could be an interesting avenue for vault protocols to function. For example, vault protocols that do these strategies like Brahma did on top of us, now they pivoted into something else themselves. Or Mellow protocol, where they were doing vaults without liquidations. So that is another way of looking at it. For margin trading, the value proposition is also different, right? Again, same contract, but different, similar product line, but different product realization, let's say. There, if you are having $100, you probably will be trading on Binance because you can never pay the on-chain fees anyway, right? So there we are not trying to solve for that user base just yet. If you are a prop desk and you have hundreds of millions of capital, it is likely you have a prime brokerage open with banks anyway, and you need such impeccable execution of orders and impeccable API that even DYDX is not going to be able to provide you ever. So they are simply restricted for the execution, right? Like this high frequency traders, what they did back in the days, they would fly to an office of not a broker, clear, like an exchange, right? And they would set up their servers literally outside of their office, and they would win because of the, how they call it, latency, right? Which when I heard it from a trader, I was like, that sounds pretty funny, but it also how it functions. So there, the value proposition is more so for people who don't want custodial risks, for people who like the DeFi already and they're in the DEX space, and for people, let's say, with a medium-sized capital. Because if you are $100 million, spot slippage is way too much for you, wherever you are. If you're $100, even 10% fee on chain is too much. If you're in between, then you're probably the perfect user. I would say any DeFi protocol would give you the same answer. The best user base for that is somewhere in between of not the exact poorest user. I don't mean it in a bad way. I mean it from the capital size, and not exactly a professional desk, because those often utilize avenues which are centralized simply because of execution that they offer that is impeccable. So yeah, DeFi is somewhere in between. And again, that's still a huge market, right? It's not bad by any means. We need to understand what our user base is, and that user base is different depending on what product we offer to them. With leverage farming, again, last two sentences. With leverage farming, we feel like we executed it decently enough, and people liked it, and they liked it organically. We just needed to add more farms, but to add it, we need to have collateral limits, and that's what V3 brought, blah, blah, blah. So we're going to continue doing it. We feel like in leverage farming, we did decently well, and we're going to continue doing so. With margin trading, that's where a bit of a question is, because to an end user, margin trading is, I want to leverage X, right? Whatever, I want to leverage something. And perps to many users seem exactly the same. So there is just a lot of competition in the leverage space when it comes to long short. So that's a bit of an issue. We have assumptions ourselves that no funding rates and no synthetic liquidity where the house has to pay you out, blah, blah. The fact that we don't have this is good. And the fact that we basically allow people to trade with infinite on-chain liquidity, we feel like this is good enough. But these are assumptions, right? And the goal is going to be to actually push it into a usable product and see whether those assumptions make sense. And if not, iterate the product, not the protocol. So that's one thing that we did wrong before. And that's every protocol does wrong. When they iterate the product, they try to iterate their underlying infrastructure. They change their core contracts, and that's months of work. That's hundreds of thousands in audits, and that essentially gets them wrecked. So you need to iterate the product. So sometimes you need to keep the same code base and abstract a lot of shit into very weird interfaces, because if you realize that you've hit it, you can change it then. And we all try to think, it's just what every developer does, and everybody who is investing as well. You think, we're going to build the most generalized thing that's going to be generalized for everything, right? And it's going to be applicable to everything. But that's impossible. It's usually impossible. A lot of products obfuscate a lot of abstraction on the top layer. And yeah, I'll shut up now. I think that's enough of it.
It's so interesting. I wanted to ask then, is margin trading going to be on Ethereum mainnet then as well? Just like how the rest of Gearbox products are?
Just to start with. Yeah, just for start with. Farming can be now on mainnet and layer 2. Again, we didn't go to layer 2s. We understand the gas fees, right? We understand some farms are better on layer 2s. We couldn't go there because we needed to have collateral limits. Similar to why Aave needed to have collateral limits for V3, which was the situation with CRV. And when you have leverage protocol, these situations become possibly even more frequent. So collateral limits were a big part of V3. There is a bunch of other interesting stuff, but related to your question, yes, we can go to L2s. The launch will likely be, again, pending DAO votes on mainnet, just because of relatively easiness of migration of capital from V2 to V3. After that, L2 deployments can happen. And we, of course, want to have them happen because there are interesting opportunities on layer 2s.
Okay, sounds good. I'm excited for that.
Yeah, also some different types of users on some of these L2s, and you can definitely offer a wider product for wider audiences.
Absolutely.
Well,
yep.
But I can definitely agree with you that, at least for now, if you really want access to DeFi's liquidity, you have to be on mainnet. The real liquidity is there. Everything else is still, as much as it's growing and it's fascinating for people like us to see and follow and even invest in, the game is still mainnet for sure. This actually leads me to two questions that I wanted to ask you. One was about institutionalized capital. How are you guys looking at this angle, if you're looking at it at all? And I was thinking about it as you were answering my previous question. And also, earlier when you showed some of the stuff on the website, I saw that you guys have some two upcoming products as well, something about LSD farming, I think, and also treasury management. So if you can also maybe expand on that and when it's coming or whatever you can share, can also be great.
Sure, will do. First thing about the institutional KYC pool, you can have here basically a restricted access on the passive side for lenders. You can do that. You can also have restricted access to borrowing that liquidity. You can also, so that basically means this institution, you can do it based on whatever permission you want. So if you change the permission rate, the outcome is going to be what you wanted to do. Another thing to note here is we can just have a different pool for passive lenders and different borrowers and only add RWA assets in there. Because for now, DeFi protocols have been against using centralized assets, right, as collaterals, but then Maker had PSM with USDC, and then it grew to over 50%. And now we see protocols accepting RWA assets even more. I feel like the next boom bust of DeFi, boom and bust, will happen from RWA personally, because it will get a huge influx of capital, but then it will get really freaking hit hard, similar to FTX scenario. But anyway, if people would want to have it, we can add it, due to modularity. Yeah, we're not doing it now just yet because we can see Aave's institutional pool, ARC, was it called, right? Basically having no traction. So people talk about it, but they don't walk the talk yet. So once they start walking the talk, we can add it. So we have it in mind. Again, modularity allows for a lot of it to be done. You can reconstruct this stuff, make it governless, make it governed, whatever you want, be it governed by somebody else. Conceptually, all of it is doable. Of course, resources are limited. Anybody can use and deploy it, but resources are limited. So we try to see what is the stuff that's needed the most today. We could be sometimes probably off and wrong with regard to it, but I don't know. That's where the subjectivity in startups comes from, right? And the second question was about the different products. Yep. So
even before you go there, I would just say that that's a great attitude. I think from a DeFi protocol, and a great view on like the true state of things as they actually are at this point, and it keeps you guys open for it in the future. But for now, it doesn't make you have to involve with it too much. I really like that approach, actually.
To
be honest, our ideal scenario, sorry to jump in, is like for the RWA stuff. For the RWA stuff, like our real ideal scenario is like, because like we really believe Gearbox is decentralized and it's built modularly so that like bits and pieces can fit in and out, right? If somebody else were to come to us and be like, we want to help you build a institutional pool, like that would be a dream come true. Not only like obviously we save on the dev side, but it's like that's real decentralization. Like somebody else is taking this module essentially of the project and like building some kind of new product around it. That would be sick, right? The same thing with like something like that. So that's like institutions. And then on the other side, if like we had some hardcore decentralization people, like the way that Liquidity is, they come to us, they're like, we want to build a pool for you that's like immutable, like it says on the slide. Like that's something we're super open to. So like in our ideal scenario, like other people are coming to us with suggestions and resources of like, we like the way that Gearbox is built modularly. We like that we can actually do a lot of the work to add this functionality to the base layer protocol. And if that happens, that would be like amazing.
How many pools are we going to start off with version 3?
When TVL was 100M, we wanted to start with one risky pool, one blue chip pool. Now TVL is 30M, so you cannot fragment what is already fragmented. So for now, starting with just the base pool for everything, but not adding any more risk stuff to it. Once the risky stuff is added, then of course, granularity can happen, right? Can't really fragment risk if the pool is fragmented by itself, basically. So conceptually allows for a lot, but probably not in the first month.
And what are the steps to kind of get back to a 9-figure TVL? Anything in mind or anything in plan at the moment?
Great question. That's
maybe this
sorry,
also, by the way, maybe this also communicates with with the second part of my question.
Exactly, it does. It fully does. So start the answer as I always do from behind, and then 10 minutes later I forget what the hell I was talking about. On-chain credit, big narrative, right? Conceptually, big primitive. But it comes to life through a few very concrete things, right? You protocol which is complex, you abstract into simple use cases that people can actually interact with. Like, what can I actually use on-chain credit for, right? What can I leverage? Conceptually, anything, but then people ask, what? What is it? So with V2, we made a bet on leverage farming. The reason for that was that farming was huge back then. Delta neutral was huge. So it was easy to onboard users, people were familiar with it, and it didn't require active monitoring of positions and interface interactions. We thought trading would be too hard to start with, which probably is true to an extent. Again, delta neutral farming is great, but again, it's a seasonal thing. So we could have waited around and just wait for farming to come back. But we thought, what is all seasonal? How do we fix the TVL and everything? Well, Gearbox conceptually, because of credit, it functions on spread. There needs to be people who are happy enough with X, APY, and people who are happy enough to borrow at X plus whatever added premium, right? And the protocol essentially pockets in between. There are other fees in place, but basically there needs to be passive side that's happy with the lower number that the active side is willing to borrow at. Pretty simple. With leverage farming, once it started contracting, which was basically beginning of this year, right? The spread disappeared. For example, T-bills are now offering more than any stable, really, apart from the new launches like today Prismas, right? T-bills are essentially offering the highest risk-free rate. That's why lending in any market has contracted. Nobody is lending to SMEs, private equity, and whatnot. People are just doing T-bills, right? Whatever maturity they want. The same thing for ETH. ETH leverage staking remained in the market, mostly because there was a supplier of ETH that never wanted to enter leverage staking, but that share is not growing. However, you can see wrapped staked Ethereum not being used as debt anywhere. It's used as collateral, so people borrow against it. But nobody can basically make risk-free rate above what leverage staking gives you. Now, that is also likely to change with the introduction of free staking or whatever other bullshit it is, which gives more risk and higher APY on ETH, right? You need spread. In the market where credit is dead and there is no premium of assets, spread is dead across any asset. Once spread comes back, it's great. But anyway, how can we foster spread? And that is in margin trading. That's where spread is higher. Because these are directional positions, people are prepared to pay high to borrow because they expect more to make. That's basically it. So one is all seasonal, be leverage farming, we continue it. And another one, seasonal. And one is all seasonal, being margin trading. And that's somewhat of a new push, yeah. Other protocols which realize on-chain credit in life, move it to something real, is, of course, leverage LSDs. We partly have it. We should just add many more. We have a bottleneck with adding new ones because of the lack of collateral limits in V2, which is what V3 brings. Another one could be treasury management. That is what I mentioned or what Amplice said. Somebody else comes in with a lot of capital and says, I want this to be managed, but I want to have no liquidation risk. So I'm just going to select my own assets and LTVs, and others are going to try to make money on it. But the LP doesn't care if they make money or not. As long as the protocol is not hacked, they make yield passively without doing anything. And there could be other use cases for on-chain credit. You could tokenize reputation, you could tokenize your kids, you can tokenize RWA. Conceptually, whatever is tokenized and whatever can be used as collateral when it has liquidity on-chain, it can be used as in Gearbox, basically.
Very cool. Very cool. Just on that point, currently passive lenders are being incentivized with the Gear token. Could you talk to us about kind of the changes that are happening with the Gear token with version 3?
Oh, yes. So they are being incentivized because, again, there is no spread. So we kind of have to foster the spread or the protocol would collapse even lower. The margin trading organic rate should basically break that cycle at some point because the organic rate should be high enough for lenders to be satisfied with. I can jump into it. Amplice, do you want to go through rate markets or shall I do it? I just don't want to take all the spotlight.
Yeah, so the question was about how... Oh, sorry, hang on. The question was about how we're going to basically wind down what we're going to do with the current incentivization, right? So, I mean, essentially, it's multi-part. The first thing is, like Ivan was saying, we're basically expecting or hoping that margin trading will there'll be a bunch of demand for margin trading, which will push rates up on the lending side, which makes it like if rates go up on the lending side because the market sees kind of margin trading as a bit more risky, maybe as compared to leverage farming. So like lenders require higher yield, blah, blah, blah. As those rates go up, then hopefully like the token incentives can be like less of the yield on the lending side. And then I don't know how much we want to get into gauges and all of that stuff, Ivan, but essentially, we're doing a huge tokenomics revamp where like I might get individual details wrong, but essentially the big picture is people who borrow from Gearbox, because we're going to have system. So what V3 introduces is system-wide collateral limits, right? So, and the reason why we need that is because, for example, if we want to expand to L2s where liquidity is not as high, we want people to be able to borrow, but we don't want people to be able to lever up on specific positions where the liquidity on those positions isn't like there's not enough to support the leverage, right? So let me give an example. Let's say there's a hot new shitcoin on Arbitrum or something. If everybody's like doing the same trade, everybody buys into that token, suddenly Gearbox and Arbitrum has like loads and loads of exposure to this one token, right? Because like all of the collateral in the system is that token. And there's just like minimal amounts of liquidity or like not enough liquidity to support the tokens that are acting as collateral in the system. Then like if one person sells the token, the price goes down on that token, then you can get into a cascading situation where essentially there's not enough liquidity to support the leveraged positions, right? Does that make sense?
Yeah, it does.
Yeah, okay. So that's the system-wide collateral limit. And along with that, we're introducing basically individual collateral limits, essentially. And the way that you increase your individual collateral limits is through use of the token.
Yeah. So is it like a voting or gauge system?
So,
okay.
It's a gauge system, essentially. Yeah. Ivan, correct me if I got any of that. Sorry?
Can you give an example, please?
Right. So let's take that previous example where there's an overcrowded shitcoin trade, right? So because there's the system-wide collateral limit, one of the ways that we're going to enforce that is essentially you have to have gear and stake it, I guess, to get access to a chunk of that system-wide collateral, right? So there are certain things that we'll deem safer that maybe like you don't need to, but for things that are more risk on, you essentially have to have gear in order to have the right to access credit.
No, sorry, I'll stop you here. You don't stake to have access. User is fully abstracted from token. That is where protocols get it wrong, where they force you to have the token to use. Again, this is new stuff. Developers have not told us shit up until 2 weeks ago, so sorry that we are still somewhat swimming ourselves. You are the first ones to hear it, basically. Yeah. So kind of an alpha. But so the rate market, conceptually, what Amplice said, everything was correct up until this point. Gauges there are basically for the following. So collateral limits are there for safety. Gauges are for the economic viability. Collateral limits is basically risk experimentation, where you limit risk. Like how now Ajna, Morpho, Euler, right? They're trying to basically, as we said before, lend in as AMLs, right? Abstract it all into, simplify it all into simply many different pieces, and abstraction would happen on top. Here, it's kind of similar. Here it is similar, but experimentation with rates was never done. For example, if I borrow ETH on Aave and they buy CRV, I pay the same rate as if I borrow ETH and they buy USDC, even though one is long tail, one is major tail asset. In a bank, usually, when you buy SPY, you pay a lower fee to the bank than if you buy some pink sheet London Stock Exchange stock, because one is riskier, one is less risky, right? So they need to balance the exposure and even explain to themselves why they even dealing with some smaller shit, because they make more money on it. But again, lending protocols have never had it. They have risk granularity, but none of them have done rate granularity. So in Gearbox case, if you borrow an asset, if you borrow ETH and you're able to leverage stake and stake ETH, you are probably not paying a very high extra rate. But if you're borrowing the same ETH and you're aping into a shitcoin or some farm that is more risky, Gear stakers can essentially tell you to pay more. It's basically an added rate on top, depending on what position you're in. Again, all of that complexity from the user perspective will be abstracted. Who decides it is Gear stakers. It's not me and Amplice deciding, unfortunately. It's Gear stakers. Some of them will say the fee should be higher. Those are probably on the lending side because they get that yield trickle down to them. Those who actually leverage borrowers, but they are also holders at the same time, they might decide for the fee to be lower. So it's kind of like a pool game, one side pulls to another. And as such, some equilibrium is established. That is basically how it functions in the back. You don't, as a user, need to know that shit. You will just see in an interface how much you're paying. That rate could sometimes be fluctuating, but rates in general fluctuate, right? As long as it doesn't fluctuate with a 2x degree, then you're pretty much satisfied, right? Because again, rates jump because they're all variable.
That is amazing. Yeah, that's amazing.
Does that make sense? So that is so that is pretty new because nobody has, at least that we don't know, who has done rate experimentation before. Economically, Aave was slightly blamed for not being able to make as much money, even being 10 billion TVL plus in bull, right? People were saying, why don't you make more? Because the earnings from borrow lend spreads, they are somewhat limited. Crypto can introduce more fees, as we see with Uniswap X, right? People are happy to pay fees. We as OGs, I guess, to an extent, we're just not used to fees. In the real world, we pay 3% to MasterCard, right? 2% for whatever. So like people are happy with fees. It's just that they're unhappy in the hour when they learn about new fees being introduced. One day later, they forget about all that shit and they'll pay as high as 5%, So that's just how it often goes. But why am I talking about this? Our future, essentially, is to make the protocol bigger, be more usable. As a result, we also need to make sure that there is some trickle-down effect from users being there. That comes through fees. If the fees are there, the token treasury grows. And then you can put 1 + 1 together after that, right? Many, of course, are fans of revenue sharing. We can't promise anything because we are not responsible for revenue. If the protocol grows, revenue will automatically go, right? That's kind of logical to an extent. And when the revenue is there, stakers or like DAO could decide to have some revenue sharing model in between. Now, would we be against it? I don't think so, right? We don't have Uniswap equity or whatever, so we are aligned, but we just don't promise it around because, again, we cannot give any financial expectations. First of all, we are shit traders ourselves. Second, we don't know how startups behave, what protocol wins. So we simply cannot say it even if you wanted to. But yeah, the idea is to have V3 offer more competitive rates, so the lending market is interested in it again. As a result, reduce the emissions on the passive side and start making more revenue as a protocol. That's like a pretty straightforward trajectory.
I like it. Just talking about the rates, how often are they going to be changed? Like, for example, let's say if there's let's say the rate for borrowing CRV is 10%. How long does that last for? When's the next gauge going to be?
Yeah, so there are utilization curves for every asset you borrow in general, like ETH, USDC, WBTC, right? They probably will be on the major pools at the start. They have the regular utilization curves as everybody is used to. They're going to be 2 tick rather than 1 tick, which is more interesting and doesn't have such fluctuations, but still it is fairly the same. The extra premium rate is decided every week, like epochs every week. But again, it's only will be likely fluctuating within the first 2 weeks when it's just being set up. Later on, it is unlikely it will jump a lot. Because similar thing, like let's say on Curve, right, when you're farming, rates change, let's say once a quarter, once every 2 months, right? And you should expect that some protocols stop engaging in the emission wars, right, and other stuff on Curve, whatnot. So here, you probably should be looking at your rates, but not like every week, because there will likely be a range where it is justifiable. The range as a capped range, I think that is being voted on when onboarding an asset. So that one is stale. So you as a borrower can expect something. Whether you're paying slightly less or slightly more, that's up to the stakers every epoch. Again, the idea is to not overcomplicate it for users and to have it abstracted as much as possible. So if whatever we just said to you, actually all of the shit we said in the past hour sounds complex, that's because it is, but the job is to abstract all of it. So actually it is simple at the end of the day.
I think that's what you guys do really well. So I can't wait for that. That's so exciting. This is actually one of the most interesting parts to me anyway about V3. I can't wait for that.
And if I may, guys, ask, like, before we wrap this up, I want to ask you guys about the future. I think about the maybe medium-term future and the long-term future. Because it's obviously watching what you guys have done for the last 2 years and what you're working on now and how, just how serious this whole operation is and has become is honestly quite remarkable, and I'm really quite astonished of what you guys are doing, and really much respect for it. But I really want to ask you guys, where do you actually see Gearbox and its presence within DeFi in maybe 1 year from now? And after that, maybe even in the much longer future, and where's the actual horizon? Where do you see Gearbox, and what's its purpose or role within the ecosystem? I don't know, 5 years from now, 10 years from now. Are you even thinking about these things, or it's only okay? How do we get the next version out, and with a much shorter horizon or view?
Sure, I'll go first. For me, to be honest, I'm only thinking about the long term, and I don't think about the medium term because I don't have to build any of that shit. So that's the devs' problem. Their job is to get us from, and I would just be like, Gearbox should be X, and then just wait for them to build it, basically. But essentially what I see is just Gearbox as a leverage or credit layer for all of DeFi, right? So all of safe DeFi. So I would like to see a bunch of different pools, potentially managed by a bunch of different people with different philosophies on decentralization and things like that. And then on the other side, essentially like you can get leverage on anything you want in DeFi, and it all happens through like Gearbox. And you think of Gearbox as like, okay, when I want leverage, like when you're doing normal stuff, you use your normal Ethereum wallet, whether it's a smart wallet, an account abstracted wallet, or just the EOA. And then when you want leverage, there's only one place to go. That's the Gearbox. You're going to use your credit account. And you think of it as a kind of credit wallet. That's what I see, right? And then you can get leverage on whatever's on chain at that point in 10 years, 5 years. You can get leverage on it if you want, as long as it's safe. That's my vision for Gearbox. That's what got me excited to join the project in the first place.
Cool. So you definitely on the Gearbox means leverage perspective of things.
Yeah, like it's access to credit, essentially. Like if you want credit, come to Gearbox. And like if you want credit for DeFi, come to Gearbox.
That's a
NFTs also, actually, RBs, whatever. Yeah, fully agree with Amplice there. He coded very nicely. Our main developer, inventor, or what he likes to be called, daddy, father, he likes to make one example, which usually doesn't land well because it's a comparison with credit cards, and usually anything card-related people see as a scam. But because you have to explain it longer, right? When you see it visually, it looks like a scam. But if you listen to it, it makes sense. Let's try. So you have a credit card. It gives you more money. You come to any shop, right? You are able to pay with it. Essentially, you have that access with more capital wherever you go. Similar thing here. If you imagine your credit account as like a credit card, you can go tap into anything within the network of integrated protocols and access it with more capital. That's the idea. We even had for one of the interfaces, he made the UI, which was like a credit card kind of thing, and it had a number. But I kind of said, let's not please do it, because all of the ICOs, which was scam in 2018, 19, right? They were raising money for making credit cards with crypto. So I was like, I feel like it's just going to get that connotation. But the concept is similar, right? Credit card applicable to anything. It's definitely not trying to save humanity. Yeah, so we are not that part of the protocol or project. We are not trying to save humanity and make the world a better place. It's a finance thing. In the real world, it's called prime brokerage to an extent. So yes, we are dirty finance people. I mean, we wish we were dirty. We are clean finance people. That's why it works half-assed. So we need to get more dirty, basically.
Well, the beautiful thing about Gearbox, I think, is like it's agnostic, right? So in 10 years, if there's some financial products, for example, like green bonds or whatever bullshit, like people are selling that they're saying is like good for the world at that point, like if it's on chain, you can ape into it with leverage on Gearbox. We're agnostic. Like all assets are good as long as they're safe.
Yeah, carbon credit's a big enough market now, so you can see it on chain. Remember that thing that the real estate scammer that got funded by A16Z again made, right? Conceptually, that will also be done and added as collateral, so you could leverage carbon credits conceptually.
Got to get in touch with KlimaDAO.
Oh, yes. Adam Newman. Yeah, that stuff, yeah. The idea was interesting. Obviously, he's a crook, right? Hope you're not going to sue me for this. But yeah, the concept could be the same. Tokenization of any asset can be brought on chain, and then on chain it could be integrated into however you want it. That's what many people see even possible for banks right down the line. Composability in that open format. You can have open format, but with restrictions, right? For safety reasons or for legal reasons. But that composability is still pretty cool. KYC rollup, I'm going to say. KYC banking rollup with Gearbox leverage on it.
Oh man, I can't wait for it. I'm so excited.
If we were better at our job, we would actually tweet it and make it go up 10%, but we decided that we can't.
Don't worry. That'll happen in due time.
Amen, brother.
One quick one. When V3?
After Istanbul or during. It's going to be, so V3 is not going to have a one big deployment. It's going to be like rolling out, and because it's modular protocol, there are many things to connect, attach, interface to connect, fix some bugs. It will be a multi-day process. So devs are slowly, they have deployed a piece of it, I think, already as is, even a week ago. And then there is another piece and another, so it might all get connected after Istanbul. Or they might do it during Istanbul at the conference. We'll see.
Okay. And margin trading coming down as well?
So yes, margin trading. So again, protocol is the same. Contracts are going to be the same, but interfaces are different. We don't have the resources to fix the bugs, everything real time on both. So margin trading launching first, end of November. Going to give it 2-3 weeks to polish it and do everything. And then end of December, essentially move the farm, not move, but reintegrate the farms from V2 into V3 and launch the new farming interface as well, end of December. But give or take plus minus 2 weeks, I think end of January, we should have the V3 fully launched, polished to an extent, and ready to start working on new integrations, assets, cross-chain deployments, and stuff like that. And funnily enough, end of December is also when most of the lockups end, which is good timing for everything in general. They still continue until next summer, but next summer is actually when it's like, that's pretty much, that's it. So next summer is like, that's it. Every new protocol is in this stage in the first couple of years, right? When it's like, up until the first unlock, people are happy, and then they're basically unhappy for the next 2 years because of listings. But you can't do anything about it, right? It happens at some point. Like, we also don't like it. We have sold 0 tokens. Tushar Muggle of our team even bought a bunch of the market at 5x of the current price. But still, if you're a token holder...
Not just Muggle, eh? I've also bought a bunch of tokens at 5, 4, 3x the current price.
Yeah, exactly. So... Yeah.
So how do you guys even make a living for now? Like, how do you even earn throughout all this?
We sell others founders tokens. Actually, that sounds bad. I hope they don't hear us. But yeah, many people in crypto, of course, are Angel on the side, right? Angel helps also stay. Many people hate it. I think it actually helps to stay in line and connected well to other protocols. I'm okay if you don't Angel, right? If you don't have the capital, you think it's bad, whatever. But I also don't see it as bad. But yeah, many have Angel before worked in other protocols, so there have been some savings. I mean, we do get salaries as well, but they are nowhere like in extreme ranges. Like they are, I would say they're pretty far below the market. It depends. For a couple of devs, they are at the market. For a couple of marketing people, they're at the market. For others, it's below. So it's more like we all believe in this shit. We sold the snake oil story to ourselves. It's an actual way to put it, right, Amplice?
Well, actually, in my case, you sold the snake oil story to me. So.
And now you're selling it to others. See, and I said you were better build the pyramids. I lied. Yes.
Do you advise anything else you wanted to touch upon?
That's yeah, I actually want to do use your guys' brains for at least one last thing that I think for some of the viewers or listeners can be useful. As like you guys are already a part of a protocol and a team that's actually done something in the space. You know, you even if it's and by the way, just like Waj said earlier, it's 2 years in crypto. It's pretty much like 2 decades of experience within any other industry. So what kind of, I see that you have an invite for Istanbul. Hope you enjoy this one as well, the Dev Connect, and maybe it's even related to what I want to ask. Because what I want to ask is, what kind of advices do you have for new projects that are upcoming now, and like what are the maybe some thoughts or a little advice on what they should focus on and do in order to actually reach the state of most protocols won't be as successful as Gearbox even is already. So what kind of small advice can you give new builders within the space?
How new are we talking about? They are about to participate in the hackathon, they just learned Solidity, they are just learning Solidity, or they have fundraised their seed round? Because the stage, because just to give you more context, I would say the advice really depends on what stage you're at. Pre-raise and post-raise.
Go for all the 3 kinds, man. Go for it.
Well, if you are just a solo dev, I think you don't have any connections to the industry, but you know some code, or you're a marketeer or wherever. Basically, you don't have much capital behind you and you don't have much connections. Even if you're a student, right? Students as well. The best thing to do, go into a startup. That's the thing. You will make some salary, so you will be able to feed yourself, but you are having unlimited exposure to the upside and unlimited exposure to learn with the high speed. So whatever you can, unless you're, of course, a doctor, right? Doctor, scientist, there is more of the traditional path there. I don't know much about it. But everybody else, yes, go into startup, do something, be active. just while you're at a startup, you'll be talking to colleagues, you'll be talking to colleagues of colleagues, you'll be meeting other companies, right? You'll be going to some meetups. Your network will grow among the random people who do either dev or marketing or whatever. Go to hackathons, try to do as much as possible. If you sit at home on your ass, you're not going to get that network going at first. You can get it once you're big enough, you can sit at home, but for now you have to do it. Then you get to the question of fundraising, right? Well, before the fundraising is difficult or different, depending on the stage of the market. At some cases, you can just write a white paper and say, listen, fundraise if you have some connections. Right now, you can make an MVP product and have 1,000 users. You still won't get any capital. So it's just the relative situation right now. So there, the advice would vary depending on your network. The larger your network is, the easier it is to fundraise for you. But anyway, once you actually get to the fundraise, you are in pre-seed, seed, whatever, life changes a lot. Because you now have expectations of people, right? You kind of don't want to scam your friends who you put in the round. You have to keep working. And another thing is you have to balance in crypto the public aspect and optics of it with the realistic things with regard to payments, right? How to run a company and things like that. We don't run a company, so we actually save from a lot of corporate bullshit. But we're a small DAO, so we haven't lost much efficiencies in between. For big DAOs, again, it's different for those structures. The point is, I feel like once you fundraise and if you go liquid, you should actually sell the top. Because people say, oh, you shouldn't be trading or anything. But what I mean by sell the top is you need to secure enough capital to last you through whatever cycle it is. And seasoned founders actually understand it. We are not seasoned. I think it's like journey 1.5 journeys for me, I think, at this point. Amplice maybe for you more. But yeah, many get high on their own supply every time. It's like, BTC is going down, you will not buy, right? As soon as it goes up, you start buying. The same thing happens with startups. People don't want to raise because they feel like we have enough money. The enough is a weird concept. You need to have enough for enough, but not over raise it because then you are just bullshit and you will never get to good valuations or good communities. I feel like I jumped a lot of stuff at the same time. So I'll jump to Amplice. He maybe can structure it a bit more. It really, really depends on stage here.
I think you gave, like in the rest of the interview, you gave a lot of, honest answers from the heart who really want to get it all out there. And I respect that a lot. Go ahead, Amplice. Go ahead.
I think my thing is much more like conceptual or simple. I think in crypto, especially if you're like mainlining crypto Twitter, like it's heroin. There's just like idea that everybody's a profit maxi, everybody's only in it for the money, and if you're not in it for the money, then you're the idiot. And I think like I don't really have any problems with people who are purely profit maxis in that sense. Like, yes, everybody is here because they think they can make money, but I think, especially if you're building a project, it's really important that the people that you're working with are like, in some sense, true believers in what blockchain technology offers the world, right? Like some part of you has to believe that this stuff is going to be useful or is useful. And if they don't believe that, I think it's really hard to build something that is useful. And if you don't build something that is useful, then ultimately your project is going to fail. Like maybe even if the coin pumps in the short term, it's going to you're going to get one of those tweets. Oh, sorry, we have to close the project because XYZ in like a year or whatever. So like align yourself with people who aren't purely mercenary. Like, yes, people want to make money, but you also there's like keep your eye on the prize of like, we're doing something important here and we're doing something important. That's kind of how I feel about it.
Alignment.
Even Ivan, who like seems like a cynic, actually fucking believes.
Very good advice. I like that.
That's true. That's very nice. That's much better than what I said. I said a bunch of like somewhat practical, misconnected things that make sense if you put them together, but it's very hard to put them together.
I think what you said, building connections, things like that really can take you a long way. I've seen it myself, so.
Definitely.
I feel like for the industry, right? For any industry, you have to do it. Once you find enough connections and some capital and you have some experience, how you juggle it around, whether you go into short-term startups or you try to just raise money and live off nice salary as a manager for a long time, right? That's somewhat of a moral decision. You need to have that base ground to actually have that even decision in the first place. So, I don't know, make content, write articles, go to conferences, talk to people, do some cooperation, whatever you can do. If you're a dev, Go contribute to different stuff, go be on Immunify, go try to research, go be in chat, just try to be around as much as possible. Which I think is a requirement, whatever stage of the bracket you're in, right? Whether it's wealth bracket or knowledge bracket or connections bracket. You do it when you are just a developer and you want to get more connections. You do it once you're fundraising. You do it once you have fundraised. You do it once you have a small product or a big product. It doesn't change. Just the close circle, I guess, might, not close circle, but like medium circle can change depending on whether you're a dev or a fundraiser or whatever else. Yeah.
Dear advisor, should we wrap it up there? We've been talking for quite a while now, haven't we?
For me, sure. I also think that you probably need to wrap up. I know we have some other stuff going on for this evening. Anything you want to add? Anything you guys want to add? Amplice, Ivan?
Not really. I would just say thanks for having us. And actually, this podcast is pretty fun to be on. I don't want to name names, but there are some things that I've been on recently that are not as fun. You guys seem turned on and actually interested, which is really great.
And please, that's how you get KOLs to hate you and then they don't buy our shitcoin. You're doing the same thing as me. Don't shit on others. That's what I'm doing every time.
I didn't name anybody.
We love everybody. Nature is going to heal us all. Market is going to go up forever. No, but I would fully agree. It has been actually a very fun 2 hours. Thank you for listening through our bullshit and actually asking very on-point questions at the right points in time. So very happy to have been on. Hopefully
definitely. To be honest, I mean, I think I could speak, ask another 4 hours worth of questions. There's so much more that I want to know, but we'll have to save that for another time.
I might send you an invoice if you actually do that. I would be happy to, but
one quick one.
Please don't send us one. Pour that. No invoice.
One quick one. Good. Will we see Gearbox on our mobile phones in the near future?
So I hate doing customer development. I have never really done it because I like hype chasing. Narratives, bullshit, snake oil. I like that shit. It's active. And now everything is so not narrative and hype chasing that we are releasing products that guys were like, listen, go do customer development. I'm like, holy shit. That sounds like to me what my boss told me when they had to do real estate SaaS research. I'm like, shit. I've done it last 2 years. So about mobile, there is a chicken and egg problem. When you're an exchange, traders say they use, so farmers don't use mobile, right? You cannot really farm on mobile, no interface, nothing is compatible with it. And the sums for farming are usually huge. So key management is an issue. So farming on mobile, it's distant. For trading, it is not distant. So when people said they trade on SEX, they said, yeah, for SEX we use mobile. It's fine because money is not yours anyway. So what security concerns can you have? For DeFi, they don't use mobile because of key management issues. Because they say, listen, even if I have like 10K, I don't want to have it on mobile, right? Because again, key can be suicide downloads and file whatever it happens with phone. So that's why we haven't seen much DeFi stuff on phone. It's not even protocol issue per se. It's wallet issue or key management issue, right? Is the key management really here is an issue. So we could adapt our interface to have it on mobile much more. But unless key management is solved, which is what we are not doing per se, then it doesn't really make much sense. Unless, it's the slide we missed actually. I thought we're never going to come back to it. But one of the things that's coming in V3 is Gearbox. That is an ability to build on-chain bots fully. So you can have a Unibot without giving us a key. You can have Unibot with leverage that is fully key management abstracted. How it works is, let's say you have stop loss or limit order. Those are also intents, right? To an extent, everything, like intent is a fancy word. Many things are intents by nature because it's an English word, right? Really. What happens is usually that logic take loss is what I would know. Take profit, stop loss, limit order. They are within an interface of, let's say, DYDX or somebody else. They're not on chain. So yes, they're usable, but they're not on chain. The thing that happens with Gearbots is that logic can be on chain. So you can make a bot yourself and make it immutable and connect your credit account to it, or you connect to somebody else's bot. You can also have it not immutable. You can have a bot that you connect to and that live feeds restrictions for you. So for instance, one thing you can do is you can have a Gearbot. You can give it essentially any of the permissions you want apart from withdrawing the funds. But again, if you withdraw the funds, they come back to your main wallet. So basically, you open a credit account from your main wallet, but you give permissions to the bot that is connected to your Telegram account, for instance. But the only thing you can do is trade, swap, or anything, right? But you are restricted by protocol anyway to buy scam coins, so nobody can spoof that money. They can execute maybe unfavorable trades for you, but they won't lose your money by default anyway, right? So you are limited from downside. Because Gearbox is a credit account, meaning a smart contract wallet with leverage, has safety permissions for itself, not even for you. So as a result, basically, you can have gasless transactions, you can have key management, you can have like auto compounding, whatever. So that bot logic is fully on chain. So as a result, yes, if we do this, then mobile trading on a margin trading from mobile on large amounts becomes doable. It's just that large amounts, maybe you kind of need to sit at desktop, right, and be able to tweak that slippage and whatever, because it's somewhat of a sensitive thing. But this would allow for mobile to make sense. Without this mobile on large sums, nobody would do them, right? Like, I know a founder who holds 300,000, who held before, even $500,000 in his trust wallet. But he's like OG as hell. He's like since Bitcoin first day. Everybody else I know doesn't store more than $1,000. And even if it's like really rich people, they still don't store more than 1,000 because there is so much security stuff that can happen. Amplice, do you have a different opinion? Because that is something I was actually about to tell you this since I just finished this, but.
No, not much to add. Just to put all that simply, will we have a mobile app? Probably not, at least not in like the next few months. But will you be able to trade from your phone? Yeah, through the Telegram bot or other like account abstracted interfaces that we come up with.
Fantastic.
So, yes and no.
Not at first though. That will take a while. All of that built in. We still have limited amount of developers, so it will take time. But as you can see, we are not sitting around. We have a bunch of ideas and products to execute on. So it's not that we are lack of ideas, because many protocols we have seen in teams, they have been like, holy shit, it's bear market. What do we actually do, right? Many were like in a limbo state, essentially not figuring out what to do. But because we have a financial product, finance never dies. Technical stuff dies. Finance never dies. It can become smaller or bigger, but it's always alive.
Ivan, you've blown my mind away completely. Yeah, honestly.
And also, I want to add one thing that I think that throughout this interview and with some of the interactions that I've had in the past with Amplice and MuggleSect as well, first of all, I think you two have great chemistry together.
There's no question about that.
Like, I really think that... and I think it shows a little bit about something that for sure really fascinates me in our ecosystem and in general, which is the organizational culture behind all these weird organizations that we call DAOs or whatever. And I really think that it probably speaks a lot to the culture that you guys have there within the team, within the community probably. And I think it's one of the strongest and most important signs of a good protocol and a good product being built is when people are really drawn into it and really create a kind of community aspect and a culture which really to me, when that's good, the chances that whatever's being built there is going to work and going to have longevity becomes exponentially higher. And it's been really a lot of fun to feel this energy between you two throughout this interview, and really appreciate you guys coming on and responding to our invite so quickly as well. It was really the best compliment I think we can have. And really thanks for coming, guys, and wish you all the best of luck, and hope we do it again pretty soon, actually.
Sounds lovely. Thank you, Vash. Thank you, the advisor. Really appreciate it. Yeah. As what you said about chemistry, just unresolved sexual tension between Amplice, that we're going to settle it this probably with the live stream. Yeah. But no, thank you very much for the kind words. It has been a pleasure chatting 2 hours. It went by quickly. The 2 hours, 3 gallons of milk, and I think I had 3 curry bowls while talking. Hopefully you didn't hear any of that. I was listening to myself. But yeah, hope to catch up soon enough, and thanks for supporting us with the launch of V3. We have merch actually, so if you want merch, we can even send it to you. Just let us know.
I think Will's sending me one already, but I'll catch up. I need to catch up with him and find out.
Nice.
Yeah, +1.
Yeah, thanks for having us.
All right, cheers, guys.
Goodbye, folks.
The advisor let us know whether she works for you. Okay, thank you, sir. Thank you for your time. Have a good day. Bye-bye.
Thank you, guys. And thanks to all the viewers as well. Thanks a lot, Waj. It was really great having you, having this one with you again. And I hope we just keep going. And have a great evening, man. And bye, everyone.
Bye.
Perfect. We'll get Sam on to end it there. That was really good.
All right.
He will be like, holy fuck, you gave me 2 hours of stream. He'll be like, I hate you guys. Absolutely.
No, I mean, this was really great. Honestly, I think it was because it is only our second recording, but I think that in a way this was already smoother on some aspects, and I really think it and correct me if I'm wrong, but we kind of opened up to actually have the kind of conversations that I was envisioning when I started thinking about such a show. Because in DeFi, you see all these interesting people and great products, but a lot of the time you just don't have enough time to dive into it and really hear their story or learn about them. And that's exactly what I think Waj and myself want to do with this new show, Send It. And it was great for us to have you guys on. We really wanted to have you guys quickly on as guests, and I'm happy that it happened so quickly.
Thank you very much for inviting us again. It was absolutely lovely. Sorry for some monologues. I do tend to go into those, trying to explain from the back a lot, and then I lose my thoughts, and then I have to explain it twice again. But yeah, it felt very natural. So I've done a fair share of podcasts, but this one's, even though it was long, it felt kind of natural and friendly. Maybe it's me and Amplice again, the unresolved sexual tension.
Yeah, there's always that, but I also really think that these kind of monologues, as you call them, I think these are great, and I think this is exactly the kind of content that many of the people that are following the industry, they want it, because they don't have the chance to hear you really express yourselves for long.
Context help, I feel like, yeah. Because when we talk, right, we can all be on the same page, but if you don't have the context, and I always like when founders or just teams or KOLs, doesn't matter, right? Influencers, right? Whoever you are, doesn't matter. Explain the thinking process of why something was done and the way it was done, because it helps you understand perspective better. Fully agree with you on that.
Yeah, I really think that people like this kind of content, man. I think that people are quite, curious about it and want to ask it. But usually when people interact with, especially with founders, I think they usually just feel uncomfortable and don't want to take too much of your time and just ask focused questions and not being banned on Discord. And you can't really, and I think that as we grow as an industry, the more we remain in touch with our actual audience and community, and our biggest challenge as an industry, I think, is to make sure that so many people actually get involved. Now, imagine how big it is for Gearbox that Amplice saw it and decided to actually get involved in it, and not just hearing about it or witnessing it from the side. And I think that
actually all of the contributors came like that. We try to do HR in a normal way, but even developers that we have just basically randomly noticed Gearbox and just went straight and just sent a message and sent whatever they did before. And that's how it happened. Amplice, MuggleSec, Nikita from the community team, Harsh, who is the backend dev, Vanyok, he's a smart contract dev. All of that happened basically randomly. So whenever we try to utilize HR properly, that didn't work. Not maybe because HR is bad in itself, but maybe we are just because such degenerate morals that when we try to utilize normal channels, it didn't click. Could be that.
Also, it's about the specific organizational culture and the culture within a specific industry. And I think it just fits much better that way and grows organically. And I think that's exactly the kind of thing that people like Waj and myself, although Waj is even more into building than I am, because he's part of a protocol these days already. I don't even know if you know about it, IVX, with Bob the Builder as well, like talented folk. And but when you create media about something, I think that one of my biggest aspirations is to actually facilitate the process of new people getting involved within the industry, not just as investors, but as people who actually work with or for Gearbox, TimeSwap, or whatever other projects we talk to in the future. It's quite remarkable, and I think that especially specifically in DeFi, which is so community oriented, the better we know how to play this game, the bigger we grow as an industry and as an ecosystem, and the faster we take over the world. And I think that's what we're here to do.
I think, you put it perfect.
Sounds exactly right. Agree. No, sounds
right, guys. I've got to go.
Good summary, good engine. Yes. Thank you very much, Source, again. Thank you very much for inviting. As soon as you have it, we'll cross-post it everywhere. I think that was a great episode.
Yeah.
We'll add a few pieces in there with a few things that I said that would let me in jail, taken out of context. So, Amplice.
Yeah, if you think of something, feel free to say. Because I think we will also extract some great clips out of it, hopefully. I think that
I totally don't mind if Ivan goes to jail, so it's...
All right, guys, see you later.
Yeah.